I think, and Feroze, I think a lot of my viewers will want to know also, with what we've just discussed and what Nilesh just pointed out, uh, how does the retail investor approach 2023 from an overarching frame of mind? And then we'll delve a little deeper.
See, I think a retail investor needs to respect all the risks, not just get carried away with one risk, because some of those risks are optically visible. Some of them are camouflaged risks, especially when we speak of inflation so much over the last 6-8 months, globally from a global context perspective and Indian context perspective, and having large amounts of debt or debt-related instruments, which is what we are the third largest economy from a savings standpoint, household savings standpoint. But when you look at the savings, are they being as productive as they could be over the last couple of decades? If you reflect back, that's where we've gone wrong. We've gone right in extent of saving. We've not transformed those savings into right investments. I think that's one thing we should correct in this subsequent years. That's what a retail investor should think of. The second thing he should think of going forward, that he should not look at the rear view mirror as much. If you look at the last 4-5 instances of people buying performance, they've gone wrong in 2020, be it the NASDAQs of the world, be it those cryptos, be it unlisted stocks, you name it, you would see that people have the tendency of buying past performance. That's one key learning we take back from 2022. Now coming to looking forward, I think all 4 assets which are there are relevant to each individual at a point in time. Not falling in love with one of them is the key investor attribute we should aspire for. Like people, I meet several people in the marketplace. Somebody who's fallen in love with FD, he will be with an FD for all his life. If somebody's fallen in real estate, irrespective of what the cycle is, they will stay with the course. So these 4 assets, all of them have some importance in this year. Unlike most of the past years, all 4 could have some weightages. Is the first point I'd make. And equity, of course, from an Indian standpoint, would be the key asset class to build for the retail investors. And they're doing a great job. Let's not take away the credit. The SIP numbers moving from 11,900 in April to some 13,500 is a great representation of an informed retail investor.
Yes.
During the most volatile times.
Absolutely. I think to pull that a little forward, Feroze, from the advisory point of view, in conversations that you have, I'm sure that you stress the importance of asset allocation. You spoke about that in the first question I asked you as well. So I'm going to pose this question a little differently. Assume that there is a new investor that is deciding to invest for the first time in January of 2023, or in fact, you have someone who has had the advantage of the last 3 years and is now at a position where they need to study their portfolio and rebalance. How do they approach the equity investment side of their asset allocation strategy?
Yes, Alex, like you said, there are different kinds of people, and there's no one size fits all. That's what personal finance, the personal word there, emphasizes it being a very customized kind of situation which we all experience. Now, let me just pull one word from what Nilesh sir was saying: expect moderate returns. I think if you're a new investor, the first thing is to understand the asset class you're dealing with, right? So you have to see that you have moderate expectations. People have very, very steep expectations with equity. They have very relaxed expectations from real estate, for example. Right? I met a gentleman. He says, I like to see my statement on the 3rd of every month. On the financial side, I said, sir, when was the last time you calculated the IRR of your second home? He says, I've bought it 22 years back. I've never calculated the IRR. But the same human being wants to see the financial assets portfolio IRR on a monthly basis, not later than 3rd. This behavioral finance aspect of putting one of them under tremendous pressure. You want equity to come from class 1 to class 10 as a child in 2 years. Real estate gets 10 years to become a 10 standard student. So don't put too much pressure on one asset. Second is, before you begin, always remember when you're cutting the check into equity, that equity markets average have fallen 20% from peak to trough every single year. Even if you remove the two exaggerated years of 2008 and 2020, 14.3% is the fall from peak to trough. So don't go looking for reasons why market will fall. Market will find their reasons. You have to decide what you wish to do when that happens, rather than just go around trying to find out the reason. This is just some foundation piece of advice because you said it's a beginner. If it's a beginner, I would assume that he or she is beginning under 30 or under 35 at least. I would say 80-20, 80 into equity, 20 into debt, assuming that you have enough gold in your lockers and you have real estate, which are large ticket items. Only that portion, 80-20, can give you 11-12% kind of a post-tax return in the current regime, with both these financial assets are very, very lucrative. Debt is giving you 6.5% post-tax lending to central government. You're getting 13-14% in active funds is possible.
Feroze, on the, and you've already pointed out on the fixed income side. So I want to ask a slightly different question. 225 basis point increase in the policy rates, as I mentioned. Now, when it comes to a home buyer, this is actually something that is flipped very quickly in a matter of less than 10 months. You were able to get a home loan at sub 7%, and now you're touching close to 9% on that home loan. If you have got a home loan, what should your strategy be? Should you look to pay quickly if you have the appetite to do that or capability? And if you are possibly thinking of buying a home at this juncture, should you put off that purchase just a bit and utilize this time to save and increase your down payment?
Yes, Alex, point one, I think home buying is more of an emotional aspect for the first home which you're going to live in. So I also personally think that that's a great utility of money, because it brings you calmness in life. It brings you more joy. You can do what you wish to do with your home, which you can't do with a rented house. So I think home buying is not a bad idea. Coming to your point of interest rate movements upwards, I think till date people can borrow at 8.25 on a home loan basis. You're speaking about Government of India borrowing 10 years at 7.3, 7.4, and there are some MNC banks which are ready to lend a home loan at 7.75, even 7.5, I've heard. So you're with an individual credit risk, you're speaking of borrowing at very similar rates or marginally higher than Government of India. So that kind of policy rates have not been passed on to the client. Point one. Point two, I think policy rates take a lot of attention of both the investor and the borrower. And I think investors never make money or lose money on policy rates. They make or lose money on 10-year yields or 5-year yields of bonds and the spreads which the corporate bonds command over the GSEC paper. Now, so point two I'm trying to get to is, today is still a good time to buy a home, provided it comes in your budget. There are 4 or 5 other ratios which are very critical when you buy a home. You have to look at your EMI to your disposable income ratio. You have to look at your portfolio to your EMI ratio. If you look at those 3-4 ratios, have a thumb rule that you're not going overboard. The more important decision is not going to be whether you're going to be charged 0.25% average more during the life of the loan. Then what time are you qualified to buy a home today? Don't stretch too much.
What are those ratios very quickly? What are those thumb rules?
Yes, so let me touch upon 2 of them, because the value to the viewer would be for me to speak less and let Rinesh speak. So I will just touch upon 2 of them, and we'll keep the topic for the another day. One very important thing is, if you're buying a down payment, if the down payment of your house is greater than 50% of your current portfolio, I'd say no. You please accumulate more assets. Sometimes what happens is people give a down payment of 30 lakhs, but their portfolio was 35 lakhs. That's not. You maximum can give a down payment of half your portfolio size. That's point. Point 2, your EMI for home loan should not exceed 40% of your post-tax salary credit. These are, of course, very broad, but at least instigating a thought to the viewer.
Absolutely. Absolutely. On that note, gentlemen, thank you so much for taking the time. Always a pleasure speaking to both of you. And once again, wishing you a very prosperous 2023.